As soon as Australia's third quarter inflation numbers dropped, the whole finance world blew up. Economists at all four major banks reversed their course, market expectations flipped, and countless buyers who were ready to pull the trigger started to hesitate. How alarming is this data? It didn't just shatter hopes of rate cuts. Some experts are now saying the RBA's next move might not be a rate cut at all, but a hike. I know you've probably got heaps of questions in your head right now. What on earth just happened? Wasn't inflation heading lower? Weren't we already in a normal rate cut cycle? How did it turn so suddenly? Where will prices go from here? Should you still buy now? In today's episode, I'll use the latest data and real historical cases to show you a truth most people struggle to grasp. Why do property prices sometimes rise even when interest rates go up? And why could a delay in rate cuts actually be the best window for you to get on the property ladder? Hi, I'm Alex. I hold master's degrees in accounting and business administration. When I worked as an accountant and then a GM of a listed real estate company, I began my property investment journey. Then I started my own company, helping hundreds of people invest in the property market to achieve financial freedom and retire early. And you are watching Aus Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. As soon as the inflation print landed, the whole financial world got a shock. On 28th of October, the Australian Bureau of Statistics released the third quarter consumer price index, and it hit the market really hard. Headline inflation rose 1.3% quarter-on-quarter and 3.2% year-on-year, the largest single quarter rise since Q1 2023. It blew past market expectations of 1.1% for the quarter and 3% annually. Everyone had been hoping inflation would keep drifting lower, and instead it turned back up. The RBA had earlier forecast that trimmed mean CPI in Q3 would rise by around 0.6%. The actual result came in at 1%, a full 0.4% higher. That's not a small miss. RBA Governor Michelle Bullock warned in a speech earlier this week that if the quarterly trimmed mean CPI reached 0.9%, it would be a material miss. Now the print is 1%. That's a real slap in the face. Even more troubling, annual trimmed mean inflation lifted from 2.7% in Q2 to 3%, right at the top of the RBA's 2 to 3% target band. It's the first time since December 2022 that the annual trimmed mean has turned up, after nearly 2 years of steady declines. Let's look at what pushed prices higher. The most significant part was the electricity, up 9% in the quarter, 23.6% over the year. The reason is straightforward. The government's electricity subsidies expired. Remember the rebates introduced last year to ease cost of living pressure? Once they ended, electricity bills snapped back, and they did so with force. Beyond power, housing costs rose 2.5% in the quarter, recreation and culture increased by 1.9%, and transport rose 1.2%. Food and non-alcohol drinks didn't spike as dramatically, but they still posted 3.1% rise over the year. Trimmed mean CPI is now giving the central bank a real headache. It's still inside the target band, but it's pressing against the ceiling. In its August statement on monetary policy, the RBA projected that inflation would continue easing and sit around 2.5% in the second half of 2025. It's not the case anymore. The rate cut cycle has turned. Just a few weeks ago, the big four banks and the broader market largely expected a cut in November. Then the inflation data hit, and everyone changed their tune. Here's where the big four stand now. Commonwealth Bank is the most pessimistic. Its chief economist said the rate cut cycle is over, with the cash rate staying at 3.6% for an extended period. No further cuts. The logic is simple. Q3 inflation shows persistent price pressure. Consumer spending is picking up, and the property market is red hot. In that environment, the RBA has no room to cut. ANZ and NAB are slightly more optimistic, but have pushed cuts far into the future. ANZ now expects the next cut in February 2026 and only one, bringing the cash rate to 3.35% and then stopping. NAB is more conservative, seeing a single cut in May 2026 to 3.35. Westpac has been the most aggressive of the four, sticking with the November cut, but after this inflation print, it has withdrawn that call and is reassessing. Financial markets reacted quickly. Before the release, traders put the odds of a November cut at roughly 70%. Once the data dropped, those odds plunged to under 40%. Markets now expect no cuts for the remainder of 2025. Some experts are even saying if inflation stays elevated, the RBA might even revisit the idea of hiking again. The RBA's own medium-term view, reflected in the August statement on monetary policy, suggested trimmed mean inflation would ease to 2.5% by December 27, the midpoint of the target band. If everything followed that script, this rate cut cycle would wind up by late 27. But right now, that script has been thrown off. The RBA has two big goals: full employment and inflation at 2 to 3%. Unemployment sits at 4.5%, a bit high, but still within an acceptable range, while inflation has jumped to 3.2% above target. In these conditions, the RBA will prioritize bringing inflation to heel rather than rushing to cut to stimulate jobs. On the back of this trend, markets see two possible paths for the rate cut cycle. First, fewer cuts overall and a smaller total reduction. Second, the cycle is already over, with the cash rate stuck around 3.6% for a long period of time, perhaps a year or two. Judging by the big fall and the market reaction, the first outcome looks more likely, but we can't rule out the second. If the next few months keep delivering hot inflation, the RBA may sit tight until price pressures cool. Which brings us to the question, if rate cut cycle stops, what happens to the Australian property market? Is the upward trend about to stop? If you have any questions about property investment, please book a free 15-minute discovery call on our website. If you want a team offering one-stop service to help you build a property investment portfolio, achieve financial freedom, and retire early, join our Vision membership by booking a 30-minute obligation-free discovery session to start with. Or to keep it simple, our data-driven buyers agency service can help. We buy and manage properties for our clients anywhere in Australia. Links to the service are in the description below. Many assume the link is simple. Rates up, prices down. Rates down, prices up. History shows it's not. Over decades, Australia's property market sometimes moves with rates and sometimes ignores them. The normal pattern is clear. From 2012 to 2017, the RBA cut the cash rate from 3.5% to 1.5%. Average housing prices rose 47%. From 2019 to 2022, rates fell from 1.5% to 0.1%. Prices climbed 35%. This year's rate cut cycle has again coincided with broad price gains. But there are exceptions. From 2003 to 2008, rates rose from 4.75% to 7.25%, and prices still lifted 32%, powered by migration surge and mining boom in iron ore and coal. Those forces brought people and money, overpowering the drag from higher rates. Through the pandemic, borders shut, rates hit rock bottom, and subsidies sent prices soaring. Then inflation jumped. From May 2022, the RBA hiked hard from 0.1% all the way to 4.35% by November 2023. Prices fell at first, bottomed around August 2022, and by February 2023, turned up again. Why? Population. As students and skilled migrants returned and borders fully reopened, demand revived, mirroring the market's turning points. The takeaway: rates matter, but they're not the whole story. Migration, subsidies, and supply constraints are powerful too. And once you zoom into states or capitals, local growth paths, state incentive, supply, and interstate or overseas migration all reshape the picture. 4 ropes pull prices: interest rate policy, supply-demand, migration, and confidence. Rates first. Short-term, they're the key lever. Q3 inflation spiked and cuts were delayed, but over the long run, the RBA still cuts, just later. Most of the Big Four now see a single cut in the first half of 2026, taking the cash rate from 3.6% to 3.35%. And that would lift borrowing capacity, flow into high offers, and reduce forced selling as holding costs fall, tightening the listings and nudging prices up. Domain and KPMG expect further gains through 2025 to 2026. Sydney's house median above 1.8 million, Melbourne over 1.1, and fresh highs in Brisbane, Adelaide, and Perth. Supply and demand may matter even more. The National Housing Supply and Affordability Council sees a 47,000 dwelling shortfall by September 2025, and it's widening over time. The 240,000 a year National Housing Accord target is only 73% met. The 24 to 25 financial year only delivered about 179,000 houses. Skilled trade shortages and materials constraints mean ramping up construction quickly is tough, keeping upward pressure on prices. And migration is the most underestimated driver. Net overseas migration hit unprecedented levels in 2022 to 2023 and stayed high into 2025, with roughly 75% of population growth from migration. New arrivals need homes. Constructions can't keep up. Migration also props up GDP. Strip it out and growth turns negative. So policy is unlikely to slash intakes dramatically, keeping demand high. Confidence and sentiment matter too. After 6 straight months of gains and record highs, FOMO builds. The more people rush in, the faster prices rise, and the cycle feeds on itself. And policy supports this. From 1st of October, the upgraded home guarantee scheme dropped income caps and quotas and lifted price caps. Sydney to 1.5 million, Brisbane to 1 million. More buyers can enter with a 5% deposit and target higher price points, competing with investors for entry-level stock. Putting all this together, I'm sticking with my call. The national market should keep rising into Q3 next year. We won't have a 30% in a year surge, but steady gains look likely. Here are my advices. Don't panic about high inflation and delayed cuts. Elevated power bills, pricier materials, and rising wages keep construction costs high. Projects don't stack up, new supply shrinks, and prices lift. Even without rate cuts, Sydney and Brisbane housing prices will keep going higher. Supply-demand-driven rises tend to last longer than purely rate-driven rallies. From an investment point of view, we're midway through a golden window. Bank stock delays, media amplifies risk, and buyers step back. History says the best returns often come from buying when others hesitate. Newer property buys should proceed with a professional team. Complete beginners flying solo might wait, as they have no way of knowing whether now is the right time to buy. Sydney and Melbourne property markets are most rate-sensitive, still in an uptrend. Better for long-term value preservation, plus steady growth than a quick spike. Right now, Brisbane, Perth, and Adelaide deserves the most attention. Perth migration is strong with a 0.6% vacancy rate. Brisbane has the Olympic tailwind. Adelaide seeing renters cross to buy. Detached houses are steadier and appreciate faster in up cycles, especially entry-level 3 to 4 bedrooms. Apartments are mixed. City and submarket matter. For first-home buyers, don't let short-term noise affect you. Be clear on purpose, owner-occupier, or investment. For investment, focus on location, scarcity, and long-term supply-demand. Using the 5% deposit scheme, watch repayments and negative equity risk if prices dip. Already own an investment? Adding one can make sense. Just don't max leverage. Keep cash on the side for uncertainty. If your finances are sound, hold your properties and don't sell. In Australia, the property market's long-term trend is always up. And the bottom line is, long-term bullish on property market, cautiously optimistic for the midterm. Don't panic sell or blindly chase FOMO. Hunt for real value and growth drivers. Use geographic arbitrage and keep an eye on the Melbourne's strong long-term potential. If you've made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos, and have a good one. Bye.